In this video, I'm going to teach you how partnership taxes work. And what do I mean by that? I mean that if you set up a business with a partner and you and your partner earn $200,000 together, okay? 50% of that is owned by you, so you get 100 grand and your partner gets another 100 grand. Then what taxes do you have to pay in that scenario? Not only what taxes do you have to pay, but what are the tax forms? I'm going to walk you through Form 1065, show you what that kind of looks like, and why that's called a pass-through entity, or you might hear it referred to as an informational return. So I'm going to show you the data that gets put on the Form 1065, and then how that profit from the 1065 flows into your individual tax return, or you may hear that form called Form 1040, okay? So if you continue watching, you're gonna learn how partnership taxes work. In fact, this is part of a video series. This video, part of a video series that I'm doing that's gonna teach you how taxes work for sole proprietorships, S corporations, partnerships, and even C corporations. Now, if your business is taxed as a partnership, that means you got together with another person and you just went out and started a business together, okay? You didn't have to have any formal documentation. That's called a general partnership. Or maybe you formed a multi-member LLC. And in that multi-member LLC, if you have multiple members, as the name suggests, you and another business partner, then by default, your business is taxed as a partnership. So this video applies to you. So if you're watching this video and you want to learn about the sole prop, the S Corp, or the C Corporation, find the other videos in this series. I'll put the links in the description below. But like I said, with this video, we're talking about partnerships. And so first thing I'm going to do is show you what taxes you have to pay. And then I'm going to show you the exact tax forms that those taxes go on. So in this example, I'm saying you have $250,000 in revenue for your business. And in order to generate that revenue, right, those sales, that means you sold a certain amount of product or delivered a certain amount of services, your customers paid you $250,000. Now, in order to do that, you had some expenses, right? You might have had some advertising, some electronics, things like that, home office, whatever. $50,000 of expenses, so your business profit was $200,000. Now that profit is split between you, partner one and partner two. I'm going to call you John in this example, okay? You're partner one. So what taxes does John have to pay as partner one? Well, you have to pay self-employment taxes. You might hear that referred to as Social Security and Medicare taxes, but it's self-employment taxes is the technical name when you're a partner in a partnership. The tax you have to pay in self-employment taxes is $14,129. Here's the breakdown. This is the Social Security portion. This is the Medicare portion, okay? Then you have to pay income taxes, and that's $9,228 for a total of $23,357. And so if you made 100 and you paid this amount, that means your effective tax rate is 23.36%. Now, here's a bit of a spoiler alert. If you want to watch those other videos in the series, if your business was taxed as a C corporation, you'd pay 27.6%, S corp 17.75%, and as a sole proprietor, 23.36% as well. You may be wondering, hey, is that a coincidence that these tax rates are the same? No, it's not a coincidence, because a partnership is kind of like having two sole proprietors come together and forming that multi-member LLC or that general partnership that's being taxed as a partnership. So quite naturally, if you've got a partner earning 100 grand or a sole proprietor earning 100 grand, the taxes are very similar. Now, let me take you over into the tax forms and I'll walk you through this. Before I do so though, let me actually properly introduce myself. My name is Navi Maraj. I'm a CPA that teaches entrepreneurs how to save thousands of dollars in taxes. I do that for free right here on social media, but I also do it through a course, which you can find more details about on my website, which is navimarajcpa.com, or the link is probably provided in the description below, depending on what platform you are watching on. But what I do in that course is basically transform entrepreneurs from a state of not knowing much about bookkeeping and all the various tax strategies, and I show you how to implement all of that step by step in a very easy to understand manner. So by the time you're done watching that course and going through everything with me, you are now transitioned to a tax-savvy entrepreneur who will save thousands of dollars in taxes each and every year. So if you want to find out more, like I said, my website is linked below as well as the course. But let's focus on the topic of this video. What are the tax forms, or how do the taxes work in a partnership? Now, if I'm being honest, and I'm always trying to be honest and transparent with you guys, is that Partnership taxation is super complex. There's no YouTube video that's going to be created to teach you this because it would take hours and hours and hours to learn all the ins and outs. It's probably the most complex part of the tax code, but I'm going to teach you this in a way that's easy to understand for an operational type of business. And so what I mean by that is, let's use a realtor as an example. Most people can kind of understand what a realtor does, so that's why I'm using that as an example here. So it's called sample partnership. This is the address. There's a real estate agency. And so the total assets of this business are $10,000 at the end of the year. But let's focus on these parts here. So we have Form 1065. This tax form is due on March 15th. Notice I said March 15th, not April 15th. You can file a 6-month extension to have this tax return pushed as the due date pushed to September 15th instead of March 15th, but it is due on March 15th. Don't mess that up. The reason why I've said that number or that date like 6 times now is because if you forget that, you will have to pay some penalties for not filing your taxes on time. So in this partnership, you earn $250,000. Again, this is a real estate agency. So we're saying, hey, both realtors that worked in this real estate brokerage earned $250,000 together. Okay, that's their commissions, all right? So that's their income. Now, what expenses do they have? The way the partnership tax return works is that if you have an expense that's listed here on the front page, then it goes on these line items here, line items 9 through 20. But if it's not listed here, then it goes on basically a worksheet, and that's where this $50,000 is. I'm saying there's $50,000 in expenses, and in my particular example, this is on a statement, and the statement is showing us that there's $50,000 in advertising expenses. In reality, you'll have way more than just advertising expenses. If you take my course, you'll learn about all the various tax strategies. So you might have home office, cell phone, internet, hiring your minor children, maybe some 401k things, items like this, okay? So you'll have much more deductions here, causing you to pay less tax. But if you're not aware of those items, then you're going to be stuck in a situation similar to this, where you just have, your $50,000 in various expenses. It might not all be advertising. There might be some office expenses and things like this. Okay, bottom line is you earned 250 grand, you had $50,000 in expenses, so your profit, your ordinary business income as it's called on the partnership tax return, is $200,000, okay? That's it. That's how you prepare the partnership tax return, but I'm just kidding. It's a lot more complex than that. Let's go to the other pages that we have here. I'm going to skip over page 2. It's a series of yes or no questions. Page 3 is very similar, a series of yes or no questions, and that even bleeds into page 4, is continuing on with those yes or no questions, okay? You can kind of learn that stuff on your own simply by reading the yes or no questions and if they apply to you. On page 5, we have Schedule K. So this is the total income that the business earned. $200,000. But there's a schedule called K1. Each partner receives Schedule K1, which tells you what of this $200,000, what portion is yours, okay? And I'll show you that in just a second. Distributions of cash and marketable securities. What we're saying in this situation is that there was $200,000 of profit, and both partners decided to take out their share of that profit. So partner 1 took out 100 grand and partner 2 took out 100 grand. And so we have the distribution showing up here on line 19A. If we scroll further down, we'll see the balance sheet, okay? The balance sheet is a snapshot in time. And in this time, we're talking about December 31st, 2023 in our example. And we're showing you what are the assets, the liabilities, and the capital in the partnership. This $10,000, you might be wondering, where did this come from? All I'm saying here in this example is that partner 1 came to the table with $5,000. Partner 2 came to the table with $5,000. They put that cash in the partnership bank account when it was first started. That's the $10,000 you see here. Then, right, they earned the $250. They had the $50,000 expenses, so they had $200,000 in profit. They pull that profit out throughout the year, okay, $100,000 each. And so at the end of the year, all that's remaining is that initial $10,000 of capital that they put into the business. So that's why the partners' capital accounts have a balance of $10,000 and our balance sheet balances, right? We have assets of $10,000, no liabilities, and we have capital of $10,000 or equity of $10,000. Here, there's an analysis of the partners' capital accounts. the combined, not individual. Here's what happened. Beginning of the year, there was 10 grand of cash put into the partner's capital accounts. Then they earned 200 grand. So that gets us to 210. Then they pulled $200,000 out as distributions, and we were left with $10,000 in the capital account at the end of the year. Each partner gets this Schedule K1. Okay, so this is the tax form that you might receive. You might have a partnership where you don't prepare the tax return for it. Someone else does, and all you receive is the K1 from the tax preparer who prepared that partnership tax return. And this is what you give to your tax preparer to prepare your individual return. And it tells the tax preparer, hey, this partnership had ordinary business income of 100 grand. That 100 grand was subject to self-employment taxes. We talked about that a moment ago. And you took distributions of $100,000. There's some more information here. We're just saying, hey, this is a 50% partner. And like I said, this can get super complex really quickly, but I'm just going over a high-level overview of the Form 1065 partnership tax return. There's some other worksheets in here. I don't want to confuse you. This can get, like I said, really complex really quickly. But let's look at, okay, I had a partnership tax return. As I said earlier, a partnership tax return, Form 1065, is sort of an informational return, a pass-through entity, a flow-through entity. Those are all sort of synonymous terms. We're just preparing this return to inform the IRS of what took place in the business. No taxes due with this return. Do you see line 28, total balance due, amount owed, line 31, 0? Why is that? Is that because you don't owe any tax at all? No, but the partnership doesn't pay any income tax. Over here on my example, you're going to see that with the C Corp example, if you watch that video in the series, the C Corp itself, not a pass-through entity. The sole proprietorship is, the S Corp is, the partnership is. There's no taxes at the entity level, but the C Corp has taxes to pay at the entity level. The partnership is a pass-through entity. So what do we have to do? We have to bring that information in, right? That information is passing through the partnership tax return and going into Mr. Sample Individual here, okay? So this is the individual tax return for that partner, partner one. We just made this information up, right? Sample Individual, a made up address, a made up social security number. And if we look here at the front page of Form 1040, this is your individual tax return. This you might be more familiar with. You're preparing this regardless if you have a business or not. If you have a job, you're probably preparing this tax return. You'll notice here that box 1A is empty. There's no value here. And that's because box 1A is what your W-2 income goes. When you are a partner in a partnership, you are not supposed to be paying yourself via a W-2. You are not on payroll. You might get paid what's called a guaranteed payment, okay? And you may get paid this self-employment income that comes in, but that's not a W-2 wage. If you ever are a partner in a partnership and you're receiving a W-2, you should start asking some questions as to why that is. In this scenario, I'm assuming you have no other type of income, okay? What I mean by that is the only income you earned is the $100,000 from your partnership. So we have here, line 8, additional income from Schedule 1, line 10. And if you were to look at Schedule 1, line 10, it says income from rental real estate, royalties, partnerships, S corporations, trusts, attached Schedule E. And I'm kind of going down a rabbit hole here, but on Schedule E, you'll see the $100,000 of income from your partnership that came through a K1. That's that K1 form I mentioned a moment ago. But let me not go down into all those details. $100,000 of total income from your partnership. You get an adjustment to income of half of the amount you're paying in self-employment tax. So I showed you a moment ago how much you had to pay in self-employment tax. To see that number again, it's $14,129. They give you an adjustment to income for half of that, so $7,065. And so your adjusted gross income is $92,935. $92,935. Then you get to subtract from that the standard deduction, which is $13,850 in the year 2023. In 2024, it's slightly higher and it's adjusted for inflation each year. Now, if you itemize your deductions and your itemized deductions are greater than the standard deduction in that year, then you'll take that greater or that larger itemized deduction. I don't want to get into all those weeds here, but basically itemized deduction just means, hey, the sum of your out-of-pocket medical expenses, real estate taxes, mortgage insurance, charitable contributions, and a couple other more rare items. If those numbers are greater than 13,850, then you'll itemize your deductions. You will also get the qualified business income deduction. It's a little bit complicated on the math here. The easy way to explain it is generally 20% of your business income of the 100 grand, but you notice this is not $20,000. There's some math going on here that's tweaking this number a little bit. If you make too little income, then your qualified business income deduction is less than that 20%. If you make too much income, then your qualified business income deduction gets reduced as well. So it has to be sort of in the middle to get the full deduction. That's an oversimplified way of explaining it, but that's how I'm going to explain it. So qualified business income deduction is $15,817. You add those two together, that's $29,667. So $92,935 minus $29,667 is $63,268. So what tax do you have to pay on that? Well, the income tax that you have to pay on that, if you're single, in this scenario, I'm just saying that our sample individual is single, you have to pay $9,228 in federal income tax. If you're in a state that has state income tax, then you have to pay a little bit more. Where's that number coming from, the $9,228? Well, there's tax brackets, right? The first $11,000 of taxable income is paying at a 10% rate. $11,001 through $44,725 are paying at 12%. $44,726 to whatever our number was, 70 something thousand, is 22% tax rate. Okay, so when you do the math on that, that's what it comes out to, is the $9,228. Okay. Oh, that doesn't sound that bad. You made 100 grand. You only paid $9,228. Don't forget about those self-employment taxes. Okay. That's the big amount here, $14,129 for a total of $23,357. Ouch, that's a lot of money. Remember, you only made $100,000 to begin with. So to be giving $23,357 to the government, and that's just the federal government. Like I said, if you're in a state that has state income tax, you got to give away more of your money. That's a lot of money. And so most of the time, I don't like to see operational businesses tax as partnerships. It's just not a tax efficient structure. I would much rather see you here in sort of the S corporation tax structure. That doesn't mean you make the S corp election for your partnership. There's other more strategic ways to do this, okay? But you can see here, there's more tax efficient ways to have your business income taxed. So that was an overview of how partnership taxation works. Like I said, this video is part of a series of many other videos. So this is partnerships. You can watch the other video to learn more about sole proprietorships, S corporations, and C corporations, okay? So if you like this video, please do actually like it on YouTube or whatever social media channel that you might be watching this on, as well as subscribe to the channel. And I will either see you in the next video within this series or within the course.